All right, welcome everyone. We still have some people dialing in, but are going to go ahead and get started. And we're recording the webinar, so those who join late will be able to catch up with us as well. So good afternoon or morning, depending on where you're dialing in from. And thank you so much for joining us for this webinar on what's a new area, an emerging area of work within the Intentional Endowments Network on integrating ESG options into retirement plans across the higher ed sector. So my name is Hannah Bowen, and I'm the network manager here at IEN, and happy to be moderating the session. And we have a group of leading experts in this area in ESG investing for retirement funds. And so I'm just going to give a very quick intro to the topic and to our speakers. Then we'll hear their perspectives for a little over half an hour. And then we will turn to discussion and your questions. So participants in the webinar are all muted, but you can ask questions or add comments and observations at any time during the webinar using the Q&A function that you see in your Zoom controls or the chat box. And as I said, the webinar is being recorded. We'll distribute it to all registrants by email and have it available on the IEN website after tomorrow. So during this webinar, we're going to be, as I said, hearing from some experts. So we have the two folks from Purposeful Strategies who are leading this work stream, the development of this work stream with the network. Chris Walker and Tony Calandro are on the line. And then we'll also be hearing from asset managers who are doing the day-to-day work of providing ESG options to talk a little bit about what they're seeing. So both Sam Stevens from Morova, an affiliate of IEN member Natixis, and Sarah Bratton from Schroders. So some of the things that we heard from you in advance of this webinar were that you're looking to understand what's currently available in higher ed retirement plans, who's doing what kind of ESG options are out there, how to present those options either to clients or to advocate for them within your own institution, and how we figure out a path forward from here. So we will cover all of that in this session. And just briefly before we dive into the presentation, for those who are new to the Intentional Endowments Network, we are a nonprofit collaborative peer learning network, and you can see a bit of all the many things we do on the screen there. And really just supporting an environment where endowments and experts can come together to advance the field of aligning investments with institutional mission and sustainability and performance goals. And we do that in a lot of ways, including gathering people together in person and virtually, like here on this webinar. So as the IEN team that's supporting this work, we're really excited to see how it's been evolving and how new areas are coming up and really expanding the forms of leadership that the higher ed sector can have in this area. So really excited about the interest in this retirement funds work. And although it's, a step beyond the endowments themselves, this is a really important area for higher ed sustainability leadership. So it has been a lot of you on this call and your colleagues, faculty, and staff who have really pushed for alignment of university resources across the board, and really seeing that, including now not just curriculum and operations and endowment investing, but also your own retirement investing options. And there's a big opportunity here, and we'll hear about that from our experts, but really the scope is huge. The total value of retirement assets in this sector is perhaps even larger, as we'll hear from the endowment assets in the sector. And so there's really a big opportunity to have influence. So we're excited to see where this work goes and to kick it off with this group. So I'm going to hand it over first to Chris Walker to talk us through a model that has been used in another sector and how we're thinking it might apply in this network and start to get some of your feedback there. And then we'll turn to Sarah and Sam to hear, what they're seeing, what's happening in practice. And then we will, as I said, turn to questions. So please do add questions as they come up throughout the webinar. And with that, I will hand it over to Chris.
Great.
Get started.
Can you hear me, Hannah?
Yes, sounds great.
Okay, yeah. Hello, everyone. And thank you for this opportunity. I'm going to give you kind of a good overview of what we have in mind for this project with IEN of integrating ESG into retirement plans. Anyone who's heard me speak over the last few years, and I've been in this sustainability space for about 19 years now, has known that this has been a pet peeve issue of mine, that there has not been in all the sustainability strategies that for the most part, I worked on the company side. The companies I've worked with would talk about their achievements. They would talk about their values. They would talk about how their employees were joining them to work for them because of their sustainability values, et cetera. But when it came down to their own employees and the engagement of their employees, particularly around where the employees might have opportunities to invest through their retirement accounts, there was crickets. For the most part, there wasn't anyone that was thinking about this really seriously. And in the 2 stops in my career, I know I had raised this, one probably too early, about 15 years ago with a company, but then more recently with a large human capital intensive consultant firm. And I heard similar arguments that you may hear if you are advocates for incorporating ESG, where it was, I was told, fiduciary duty, and we would have to give up on return, et cetera, to do so. So what we're hoping to do with this project is help you, the champions potentially of this idea, to advocate internally within your organizations. So if we move to the next slide, this is a kind of high level what we have in mind for the project. And I think, the key thing, or one of the key elements I would say, is particularly in the higher ed space, your employees are probably even more motivated than what I'm going to talk about in a minute, another project we did with companies, to have some type of alignment with their values. I think the university space writ large would be a lot more socially and environmentally aware than their, say, corporate counterparts. And there would be, I think, even a greater groundswell of interest to potentially have alignment. And having recently joined the university, a very large university here in New York, I was shocked to see when I tried to sign up for my 403B plan that the help desk, as well as some of the plan professionals, could not find the ESG funds, which supposedly there was 1 or 2 in there, but they could not find and locate the funds. And as a motivated individual in this space, I kept at it, but you could imagine how many opportunities are lost because even if the funds are being offered, they're not necessarily being highlighted or made aware for the average employee. Go to the next slide. So this is the idea of this project is based off a project that was launched last June with the World Business Council for Sustainable Development. It's called Aligning Retirement Assets, and I had led this initiative at the WBCSD. And the simple idea was we had 200 companies that were arguably the vanguard companies, the companies that said that they were the most active on sustainability, were probably kind of leading the charge on various initiatives. And yet, when we asked them about their retirement plans, both defined benefit and defined contribution plans, there basically was no one that was actively engaging their employees, at least in a robust way, to offer opportunities for investments. And so we decided to run a project where the companies were able to participate for free. So this way, we didn't want that as a barrier to entry. But where the project was paid for by asset managers who had an interest and a knowledge of the space. And so that you can see on this slide, the asset managers we worked with, and as well as PRI was a key contributor to the project. They were very interested in seeing how you could move dollars into aligned ESG type of aligned investments. I will just note on here that one of the key elements here was that there was a lot of human capital intensive entities. If you see the big 4, for instance, here, And I thought that was very interesting because it showed that this was something that they thought their employees might really care about. You can move to the next slide. So for the IEN project, we want to do something very similar. The asset managers, so thank you Natixis and Schroders for being our first two asset managers. We're looking to potentially add no more than 2 or 3 additional asset managers that are basically funding the project. Mercer will serve as a consultant as they did in the prior project. And we're hoping to invite PRI and potentially even the Pension and Investment magazine to be collaboration partners to get the word out. What we'd love to do is have 10 to 20 of the institutions on this call and in the IEN membership to participate. This is important because what we'd like to do is survey these core institutions that would participate to understand what barriers they are facing, how to try to uncover what that question was that Anna raised earlier, which was there's an inquiry about how do we advocate for ESG alignment. This is an opportunity for us to dig into what is potentially impeding the opportunities, who needs to be convinced, et cetera, so that we can kind of develop some toolkits to assist you. Go to the next slide. And I'm just going to touch on this lightly, but at WBCSD, we did a meta study of 9 market surveys of employees to see whether this was something employees were potentially advocating for. And what we saw was that in almost universally, there was at least a 70% interest from employees to have investment opportunities in their retirement plan that coincided or aligned with the values of the entities they were working for, but as well as potentially their own values. And these numbers and Natixis will show you some further information on this, but it's even higher with millennials and with women. Next slide. In addition, the U.S. Government Accounting Office had done a survey of a meta-study of ESG investment and found that basically 88% of the scenarios showed a neutral or positive relationship between the consideration of ESG data and financial returns. So in the sense, you're not giving up, there's no concession here. There's no giving up of return to participate or to have ESG fund offerings. This isn't the early stage of sustainable investing. This is where there's an opportunity to have both your cake and eat it too, so to speak, have values, but also a return. And there's been studies by Deutsche Bank and Harvard, et cetera, that were meta studies as well that came out with similar results. Next slide, please. So what we want to do is figure out how do we help you find the change agents in the retirement plan governance. We want to help the champions who, for the ARA project, tended to be the chief sustainability officers. So how do we give you the right tools to champion and advocate, and how to overcome what we had heard were the 3 main barriers, which was fiduciary duty, performance, so this idea of some type of subsidizing performance or subsidizing criteria or risk, et cetera, and then employee interest. Next slide. So I am going to just say that we did not find, and we worked with Baker McKenzie, actually did some excellent work around the world on looking at fiduciary responsibility. And the feeling is that the clarifications from the Department of Labor last year did not really fundamentally change the opportunities to consider ESG funds as part of the offerings to employees. Next slide. So how do we help you? What we in a survey of our companies with the ARA, it was found that while there was about a 47% split in each direction of companies that had robust sustainability policies that took employee engagement into account, and then there was also 47% that said that they had a sustainability policy, but they did not take employee engagement in account. What we would say is almost it was a universal 100% that did not look for ESG, did not offer ESG investment options in their funds. And so what we want to do is actually help in this project, help identify, what are these barriers, what are the opportunities, and how do we overcome some of the fears, and the fears of particularly of concessions. Next slide, please. So with the ARA project, and for this project it would be very similar, we want to do two toolkits. The first toolkit is what is a sustainable retirement plan? And the second was how to develop a sustainable retirement plan. These are both available. If you go onto the World Business Council website, you can take a look at these publications. But we'd highly recommend that these type of toolkits are very useful when you're trying to talk to your peers in your institutions. Next slide. And as a result of the ARA project, we had a lot of companies kind of act upon what we were working on. So Pirelli ended up offering a 401k option. Bloomberg, prior to the start of the project, had initiated a 401k. S&P, KPMG, et cetera, all developed 401k offerings. We think with the 403B plans, there may be even a little bit of easier argument, particularly on the fiduciary duty side, because you're aligning potentially with the underlying mission of your organizations. And so we think that will be something that we will look a lot closer at in the development of the toolkits. And then here are just a few guidelines to consider. But what we really want to do with this project is make it interactive and share best practices. That is the key. How did you overcome this barrier? What happened here? What are the considerations that you should be considering? That will be all part of the integrated approach that we will develop. And with that, I'll hand it off to my colleagues.
Wonderful, thanks. And in the spirit of starting to get interactive and hearing some different perspectives, we're going to first turn to Sarah. And if you can walk us through a little bit of what Schroders has learned about integrating ESG and sustainability in this way.
Great, thank you. I just want to high level, I'm aware Schroders isn't always a household name in the US. Just a little background on us. Schroders is a global asset manager headquartered out of London, England. We have over 600 billion in assets under management. We operate in 32 countries globally across the spectrum. So equity, fixed income, multi-asset, private assets. We have various investment capabilities. We established our sustainable investment team at Schroders over 20 years ago. And it has been a journey for us, and we really welcome you to join us along this new journey on really helping you to incorporate sustainable investment solutions into your portfolios. So sustainable investing is really not that simple. And what are some of the common barriers we continue to come up against? Well, first of all, it's confusion over definitions. We, as an asset management industry, haven't done ourselves any favors, whether it's ESG investing, sustainable investing, impact investing, SRI investing. There's a broad spectrum of definitions, and it's really working. We spend a lot of time with our clients, the first part of the meeting saying, helping to understand their sustainable goals and where they really fit in along the spectrum. Another thing is performance concerns, and many of those concerns really date back to what was traditional SRI investing, where you were really screening out industries. ESG and sustainable investing is much more than just screening. It's really about understanding the long-term sustainability of a company's business model. There's a lack of transparency. Or you're saying your fund is sustainable, but how can you truly prove it? And then, again, questions over your members' use. What is really important to your organization? Next slide, please. So every year we have a institutional investor survey We surveyed over 600 institutional respondents across the globe. This accounts for over 24 trillion in assets under management. Of those 650, 175 of them come from North America, and then the bulk of the rest of them from Europe and Asia, and a portion from LATAM. And it's not just us in North America that find sustainable investing difficult. You can, across the globe, there's investors that find it very, very challenging. Next slide, please. But what you'll notice is that it's growing, and over 2/3 of the respondents believe that it's going to become more and more important over the next 5 years. And I would really like to highlight that North American number, and the one that you've really seen drop is that yellow bar that I don't think there's anybody in this room that thinks that ESG investing is going to become less important, whether it's due to better returns or pressure from our stakeholders or pressure from society in the forms of regulatory pressures. This is going to continue to explode and become more and more important over the coming years. Next slide, please. So again, what are those barriers? There's three major barriers that we often come across in our conversations with clients. That first one is performance concerns. That goes back to, the screened investing of the past, which is what many people still associate with sustainable investing, but also many of the options that were originally out there were passive or ETF approaches, and they were based on third-party data, and many of these indices did underperform their traditional benchmarks because these third-party data are actually a contra-indicator for controversies. So they actually get downgraded after the controversies happen, get kicked out of the index, but you get no positive performance recovery. Lack of transparency and reported data. That's something that we're working really hard here at Schroders to come out with standardized sustainability reporting. So investors really understand what their sustainability exposures are in the portfolio. And again, we don't think that this should be in lieu of any financial reporting. We'll report this on the same fact sheet that we actually report our financial returns as well. And then cost. We don't think it should cost investors anything more in terms of fees to invest sustainability, and then bringing it back to performance. We don't think this actually costs performance at all. We actually think investing sustainably leads to better risk-adjusted returns for our clients. Next slide, please. So how does ESG matter? There's three really simple ways that ESG can enhance performance. There's been a pickup in sustainable growth. So these are companies where management is truly executing on their sustainability strategy. It's been shown over time where you often make your most money is identifying those ESG improvers over time. Number two is avoid high-risk companies. So it's that moment you wake up, it's all over the newspaper, it's a scandal. If you're in an emerging market fund, sometimes you can't, there's no liquidity, you can't even sell the position. It's fraud. These are investors' worst nightmares because we always say at Schroders, we hate to underperform the benchmark. We hate even more to lose our clients' money. So again, avoiding those high-risk companies, avoiding those value traps that may be priced, risk may be priced in, but it may look attractive. And the third thing is engagement. And that's a big thing for us here at Schroders. Last year, we engaged with 2,200 companies across 50 countries globally. And we are active owners, we are not activists, so we're really working together in partnership with our companies to incite change. And it's working over a longer time horizon. So we've been tracking our engagements back to 2005, and we found that it takes about 2.5 years to really incite change in the business and see that come through in the return. So these are three really simple off-the-bat case studies without even going into any investment specifics on how we truly believe over time ESG can enhance investment performance. Next slide, please. And this is a lot of, this is a piece of work we had done. Everything's available on our website. And it was looking at ESG best practices across the asset class, and best practices by leading asset owners. And it's really creating that clear ESG policy that is consistent with your beliefs, your objectives, and your circumstances. I believe is particularly relevant for this group here. Having that multifaceted approach, it's not just putting your equity portfolio, but how are you going to reach, how are you going to invest sustainably from a total portfolio perspective? And we've really been doing a lot of work on this from a multi-asset context on a sustainability budget, much like many of you have a risk budget within your portfolio. Becoming an active participant in industry organizations or initiatives like we have here. And then transparency and reporting on your stewardship activities. We truly believe that this is something that fiduciaries and clients are going to continue to demand of the asset owners, as well as asset managers. Thank you.
Great, thank you. Sorry, I'm a little slow on the muting and unmuting. Really great perspective, and we'd like to go through one more before we start turning to questions. But again, feel free to start adding any new questions as they come up. And first, we will turn over to Sam with Morova to share what you're learning and examples as well. And we may have an audio challenge there. Let me see. Sam, it looks like your line is unmuted, but might be muted manually. Unable to get that audio working. I wonder, Chris, if you have some points you could jump in, Chris Cleary, with a few while we see if we can get Sam connected.
Yeah, I mean,
sorry to put you on the spot mid-webinar.
No, it's okay. I'm actually there's another meeting going on our floor, so please excuse any background noise.
Yeah, it sounds nice and clear.
Yeah, so what we've focused on in terms of what we wanted to speak to was kind of the conversation around ESG and our findings here. So we did a defined contribution investor survey, and we just released some results just recently. And what we found was that, so in 2025, we believe that 75% of participants will be millennials. And of that, we think that we found that 71% of those would want to invest more, or at least invest.
Hi there.
First.
Can you hear me?
Sam, you there?
Oh, yes. I'm so sorry. I have no idea what happened.
Okay.
No worries.
Well,
all right.
I was just starting off on our statistics. I had a little, and just wanted to I was diving into kind of the stats that were on the page. Unfortunately, I'm not directly in front of my computer, so I was just kind of shooting a couple of statistics to these folks here to kind of get the conversation started. So I'll turn it over to you.
And it seems like you might be back on mute. Apologies for our
Yeah, I'm sorry, guys.
Some days it just doesn't cooperate.
Let's see if we can get her back on. Unfortunately, there's some folks. So I'm not directly in front of my computer, but I mean, I can kind of continue on to the conversation or the points that I was making there. Is just that we were finding that ESG offerings or just sustainable investment options in a plan is something of interest to a lot of folks. And given that where the trend is going in terms of millennials, it seems as though it really does make sense. But at the same time, there really isn't many ESG offerings within those plans. I think even Chris was talking about it earlier, just mentioning of kind of the options there. They're really the plans themselves, although the participants are interested, it does not seem as though the investment options are lining up with that. And really sorry, was that Sam, was that you?
Can you hear me? I changed phones, I still don't know okay.
Yes, you're on. I'm gonna just let you roll with it. I just was going through the statistics and I'll let you go from here.
All right, I'm so sorry about that. So demand for ESG, to conclude on the statistics, demand for ESG, it's very clear that the demand is there. It's going to continue to grow as millennials gain more economic power. There's no doubt that there will be demand just from those drivers, but then there's also potentially demand that will come from the consensus around the need to act on certain sustainable development issues like climate change. But in our view, the demand side is really only one side of the story. For us as an asset manager, it's not necessarily our main reason for integrating ESG into everything we do. Instead, we believe in ESG because we truly believe that it has profound economic value. So I think this is the third slide, I believe. So responsible investing, which I'll generally refer to synonymously as ESG investing, often gets a bad rap because it gives the connotation of foregoing returns to create environmental or social impact, or that it allows for an indulgence of preference or belief around sustainability issues rather than really focusing purely on the financial side of things. But ESG done right, in our opinion, or ESG done in a way that might work with these sorts of plans is not so much about ethics as much as it is about creating a research advantage. It's about doing an even more thorough due diligence and about integrating the interconnected systems that define the world in which we live in our fundamental analyses and in stock valuation. So as we've already mentioned a little bit, responsible investing began with negative screening. So basically excluding certain sectors or certain companies around the time of apartheid. And these were mainly ethics-based exclusions. And to some extent, they still exist today. Catholic or Sharia funds are one example. Calls for fossil fuel divestments are another one. But with time, the industries moved more towards positive screening, so making a point to include the good rather than just exclude the bad. This gave rise to best-in-class and best-in-universe investing, where strategies only include the very best sustainability performers in each sector. ESG has since moved again and away from values-based investing towards integration, which means a deeper due diligence that includes ESG criteria in fundamental analysis and or valuation. The goal of ESG integration is to identify more resilient investments without necessarily thinking about the overall sustainability performance of the strategy. So going sort of a small step in that sustainability direction, impact and thematic strategies are trying to avoid profiting from unsustainable behavior, whether it's coming from the company's products themselves or from their practices, while also identifying more resilient investments. So they still put performance first, but they make a conscious effort to contribute to a better world. And shareholder advocacy through proxy voting and engagement is often one of the key ways these kinds of strategies try to affect change and ensure more durable returns. It's important to understand which of these is most in line with the goals of the organization whenever we're talking about ESG. And along the same vein, I'd like to mention that ESG options exist across asset classes. So equity funds, sustainable equity funds that use one of the approaches I just mentioned can be, US, international, or global in scope. Some are thematic and focused only on the environment or focused only on a particular sector. Others are focused only on a particular theme, like carbon neutrality, and others are fully diversified across themes and sectors. Fixed income funds are often sort of centered around or have a green bond component because green bonds are sort of the best fixed income offering to provide some positive environmental impact with still good financial portfolios. But going forward, I'd like to focus a little bit on sort of this ESG integration impact thematic strategies, these strategies that are really putting ESG at the core of the research process, because all of them recognize first and foremost the economic value of integrating new information about non-financial factors into investment processes. Next slide, or maybe the one after. New transparency around companies in general has, about the way they're looking at ESG criteria and addressing their related risks has been a game changer for investors. In the past, I believe the statistic is something in 2011, only about 25% of companies were reporting on, within the S&P 500 were reporting on ESG information. Not necessarily very granular, but just some information about their sustainability, the way they're thinking about sustainability and ESG. And in 2017, this was about 80%. So now instead of only having financial regulatory filings to analyze, investors have a much broader set of information before them. And this allows for deeper analysis of the company's practices. So deeper analysis of governance practices, for example, making sure there's good balance of power, that committees are independent, that committees are thinking about the company's key environmental and social impacts and the impacts that the environment or social issues might have on them, their remuneration is fair. All of these sorts of things can help investors avoid business ethics risk. And Volkswagen is a really great example. So prior to 2015, we had already excluded VW from our investable universe on ESG grounds. It had no environmental commitments to reduce the carbon intensiveness of its products in a sector where most actors do, and we had seen major shortcomings in its governance mechanisms. Not only was the audit committee only 25% independent, but the compensation nominating committees were not independent at all. There was no transparency on remuneration, no long-term visibility on the company's strategy, and generally poor business ethics practices. So looking at these factors indicated to us that something wasn't quite right, that risk related to fraud and litigation was a little bit too high for us to be comfortable investing. And it turned out that that risk did realize itself. Similar examples exist for environmental and social factors. Looking at physical climate risks, for example, can help investors understand if a company's supply chain might be at risk as its agricultural raw materials are produced in an area that will be negatively affected by heat stress or flooding as the climate changes. Looking at carbon footprints can help us understand exposure to regulatory risk or to transition risk. And understanding a company's overall culture around health and safety and how it ensures fair working conditions can help limit surprises related to accidents and shutdowns. This kind of research leads to more thorough analyses and can only add to an investor's due diligence and enhance long-term risk return. On the last slide, I'd like to touch briefly on the DOL's guidance. As we know, ERISA requires fiduciaries to act with care, skill, prudence, and diligence that a prudent person would use and act solely in the interests of a plan's beneficiaries and for exclusive purpose of providing benefits and paying reasonable administrative expenses. Collateral benefits, so basically any benefit created apart from the investment return to the plan, cannot be used to justify taking greater investment risk or sacrificing investment returns. So this can make purely values-based ESG investing difficult to discuss or justify in the context of these plans. But strategies that focus on ESG integration look first and foremost at doing the key job of any investor, choosing the best, most resilient, most performant companies and projects to invest in. That is the core of an investor's job after all. Managers that are looking at ESG in their fundamental analysis and adjusting their valuations and allocations accordingly are maximizing their information inputs. So everything we do takes ESG into account, and in our view, that just means we are doing the deepest due diligence we can to make sure our investment choices are as well informed as possible and as likely to generate alpha as possible. I find that focusing on the economic value of ESG for plan sponsors and participants has been really helpful. Framing it as going beyond values-based and as being a version of enhanced due diligence can be powerful to shift attitudes away from preconceived notions of responsible investment. So while not all investors are governed by ERISA, the confusing and changing guidance sometimes does cause confusion and challenges around ESG investing in general. But we really believe that it can be a powerful tool for generating long-term returns. Doing research by looking at ESG factors is, in our view, completely in line with the requirement to act with care, skill, prudence, and diligence. So as we see it, instead of just asking why responsible investment managers consider ESG, should also be asking why not to those who don't.
Fantastic. Thanks, Sam. So a whirlwind view of considerations,
sorry about that,
possible considerations, and I think addressing actually a lot of the questions that were submitted in advance around, in particular, what does this look like as a kind of whole portfolio perspective, and what kinds of questions can be can be raised and can be answered. So before we turn to a few more of those questions and dig in a little bit further into some of the details, wanted to just give a quick preview of where we go from here, and that might prompt additional questions about best ways to get involved. So Tony and Chris Walker, do you want to just do a quick snapshot of what the next 12 to 18 months may look like for the network and ways that folks on the call can get involved?
Yeah. Anna, can you hear me?
Yeah, sounds great.
Yeah, next slide. Let's go to the next slide. So here's, you can see that I won't go through every timeline here, but the key thing on what we want to do next is, this is really the soft launch today. As Chris mentioned in the beginning, we want to do an internal survey of IEN members to really begin to identify the common barriers that you all face to integrating these funds. We also want to find out who are the key actors, the key decision makers are going to be. And then you can see these different timelines. And the only other thing that I would add to this is that there's going to be a significant communications and thought leadership strategy that goes part and parcel with this, both internally to IEN members, but also externally. This is a growing topic, and there is a lot of media attention on this, as well as different groups want to hear more about it. So we'll be very aggressive in communications and also identifying different venues to go speak and share best practices and the results of the toolkits as well.
Great, thank you. And we're really excited to see where it goes and to see where the interest from this session and further conversations take us. So want to spend the rest of the time really digging in a little further with some questions that have come up in advance and during this session. I think many of the questions around kind of what is the state of play right now were covered in the presentations. So I want to hop to a whole set of questions that we saw around how do we make this a reality at higher ed institutions. So the first question would be, how do we present sustainable investing strategies? If you're in a firm, maybe how do you make that kind of pitch to clients that this is something they should be factoring in? And if you're in an institution, how do you put this in front of the decision makers? We saw in the early slides that kind of complex decision-making structure. How do you convince investment committees, convince decision makers that this is part of their responsibility to offer?
Maybe I'll just go first and say that what we found with the companies was very similar to what I would expect we will find with the higher education institutions, in that in general, this was just something more out of, you could say, a negligence and anything else that they had not thought of or had not considered, particularly the plan sponsors and responsible parties. And so the idea is to kind of well arm whoever it is that's going to be advocating the rationale for doing an ESG options. And I think this is where we will develop some toolkits. The first toolkit is just to kind of, why would you want to do this? If it has any, what I would suggest is we do something very similar to what we had done with ARA. A lot of what we addressed in the why publication in the first toolkit with ARA was done based on the survey we had done of the entities that were participating in the project. So what was preventing them from doing so? Who were the key individuals that they were running into opposition from? Some said, for instance, legal counsel, et cetera. So how do you go about kind of making an argument as that this is something that you would want to do? And then the second toolkit would be, how do you actually develop it? And we think that there is, through case examples, we can kind of encourage people to want to follow if their peers have already gone down this route. Why aren't they? And I think that's would be at least one idea for approaching it.
That's great. Any of our other panelists have a thought on that advocacy, internal advocacy piece?
Yeah, this is Sarah from Schroders. I think there's a couple of things, and I think both Sam and I touched on them throughout our presentations. And I think both Natixis and Schroders are very aligned in the thought that this will lead to better integrating ESG and sustainability will lead to better long-term risk-adjusted returns to our clients. And we've been developing a lot of tools here internally, and one of them is a proprietary tool called Sustainix. I'm not really going to go deep into it, but what it really does is it looks at 9,000 companies, the ACWI IMI, and it says, it takes those companies' externalities and says, like people, every company either contributes or detracts from society. And if society were to pay you, give you a bill, what would you owe or what would your credit be to society today based on the externalities that you produce? So we did this across 47 impacts, and we came up with a cost for each of those 47 impacts. And we actually tapped an area, it's not Schroders spending costs on them, we tapped an area that has a ton of research, which you all know, which was we tapped the academic community to really get a cost on some of these externalities. And what we found is quite shocking. Number one, this may sound like pie in the sky, but this is unfolding for our eyes, whether it's in carbon taxes. There's actually more carbon pricing. There's actually more sugar taxes right now than there is carbon. Tax loopholes being closed, minimum wage regulations. You're seeing these costs passed back onto companies in terms of regulatory sort of burdens. And you're seeing sort of societal pressure grow. Really, since the financial crisis, people are expecting more of the companies. It's not just how much money you make, it's also how you make it. But really, in the tool, if you looked at the entire investable universe, if all of these costs that companies pass and these externalities that they create on society were passed back to the companies, 1/3 of those companies would be in the red. So I always sit back and I put it back into my own view. I want people managing my money over the long term because I'm not retiring tomorrow or next week in another year. And I think that's what we're all doing here, managing people's money for the long term. It's really important that we understand the potential risks to a company's business model, and we're factoring them in over the long term. And if we do that over the long term, that integrating these issues is just a better way of investing. And that definitely came through to me that Natixis and Sam have a very similar type view on that.
Great, thank you. And I think we have time for a couple more questions. So one that came up is, are there any universities that have already added ESG options to their DC plans? And both panelists can weigh in if you have examples that come to mind, or if anyone else on the line is doing that already or knows of others who are, you can add that in the chat as well, and we can see who's working on what.
I would say, just from my own personal knowledge, I know NYU has a couple of options in its 403B plans.
Great, and I think that's going to be one of the early pieces of this work. It's not an area that we as a network have mapped fully yet, and so really, trying to figure out who is leading in this work, and where is their interest that just hasn't been realized yet. And by coming together and sharing some of this intel across institutions, can we move it forward? So a somewhat related question perhaps about who's doing this so far is, what are advisory or outsourced CIO firms offering in this arena, and kind of what's the landscape out there in terms of what's available from external sources?
That's a very good question, and I don't know the answer. I'm wondering if any of the asset managers do.
That is a really great question. What I can say, and I don't really want to name names, but we are talking with a number of OCIOs who are building out their sustainable investment lineups and solutions, and they're looking at it, really interested to look and hear about it from the approach, again, where we're talking about that sustainability budget. How far out do you want to go with it? Like every bit of investment, there's a little give and take. Are you willing to have a company that may not be so sustainable, but you're going to underweight it? What is your investment goals? What tracking are you trying to achieve? So we are working with, from an asset manager perspective, working with a number of the OCIOs to get our products on their platform.
Yeah, this is Chris with Texas. I would say I would agree with Sarah. We work with quite a few OCIO firms as well. Also the more traditional consulting houses and things along those lines that also have some OCIO platforms. They've built out, I think, a few different ESG platforms and kind of looking into their ESG options. This has very much been a discussion for them. I think it is kind of, to what Sarah was saying, looking into what exactly they're looking to get out of this, what exactly each individual client is looking to get out of this. But I do think it's definitely a topic that's on the front of their mind, topic of discussion in every meeting. Acting on it and things like that has maybe been a little bit slower, as it is with kind of these institutional type mandates, but I do think it is a topic that people have certainly been discussing and really looking into and doing their due diligence on. So I would just really second what Sarah was saying.
Great, thank you. And I think that is going to be another area that, particularly for our network and for kind of the back and forth between how ESG is being integrated in endowment management writ large and in retirement funds, hopefully we see some kind of lessons learned back and forth. And maybe at some institutions, the endowment will be the way in, and then we'll open a conversation around the retirement options available to staff and faculty. In other institutions, it might work the other way. So it's, yeah, I think going to be really interesting to see how everyone in the ecosystem is working on this. So one last question that came in, and I know there are more questions out there, and so we'll be happy to follow up post-webinar as well for those we didn't get to answer. But there is a question on, do you find TTEEs are adopting language in their IPS in regards to fund manager selection criteria? Anyone want to take the investment policy statement question and what you're seeing?
This is Chris again. I haven't heard of it being integrated fully just yet, but I do know that is, I would say, in terms of the ESG kind of parameters, criteria, anything along the kind of that level of due diligence, I don't think it's been included in IPS or in the language of the IPS. But I do think, as kind of Sam and Sarah alluded to earlier, it should fit within the criteria that is already within the IPS, so that the returns, the Sharpe ratios, whatever exactly they have written in there, the kind of the risk metrics, the return, whatever it may be, that they have kind of the standard that they're looking for. I think that those ESG mandates would fit within that. But again, in terms of that extra layer of due diligence, I haven't seen necessarily that type of language in an IPS just yet.
Great. And just a quick plug and reminder as well that on the IEN website, we have a number of resources that you can navigate to under the roadmap for intentionally designed endowments, including a look at what other institutions are doing. We don't yet have a lot of resources up there on retirement options, and we'll be building those out as part of this work going forward. But you can see examples of endowments, IPSs on there, see what else has been shared by members. So I would encourage you to look there, and happy to direct people with some links post-webinar if that's helpful. So we're just about at the hour. So I want to say a big thank you again to Chris and Tony for helping lead this work and for gathering information over the next few weeks and months from across the network to really build it out and make it as useful and valuable as we can for members and for our broader network. And a big thanks to Sarah and Sam and Chris as well, and the teamwork for jumping in with audio challenges, for bringing your perspectives. And as I mentioned at the beginning, we're just really excited to see how this extension of the principles and leadership of higher ed in sustainable investing is moving into new spaces. So really excited to follow up with all of you on the call over the coming weeks and months to shape this initiative and really, again, make it as useful as possible. So keep an eye out for that survey, keep an eye out for opportunities to join. As we said, we're looking for kind of core members of this working group and looking for additional asset managers to come on board and help steer it. So just send me a note or follow up with any of us after the webinar. We'll also be sending out the recording. So if you have colleagues who may be interested, this could be a good way to start that conversation. So keep an eye out for that. Thank you all again for joining, and we look forward to continuing the conversation. Thank you all.